Hey everyone, welcome back to Alpha Insights. I'm Harper, and today we've got a big one on the oil market. And hey, if you have questions while you're listening, drop them at stockalpha.ai.
And I'm Juniper. We're watching a tight choke point in the Middle East that's already moving prices and adding real uncertainty to global markets.
So, the short version, Iran has stepped up control of the Strait of Hormuz, and traffic through the strait has collapsed. Right now, only 6 ships a day are getting through, compared with a normal run rate of about 135.
Exactly. That waterway handles roughly 20% of the world's traded oil. So when transit slows like that, traders take notice. Brent crude jumped to about $116 a barrel on that news.
Yeah, honestly, I was a bit surprised by how sharp the reaction was. Insurers and ship owners are rerouting, delaying, even suspending voyages. And that pushes up freight and insurance costs, which shows up as a higher effective cost of delivered crude.
U.S. crude benchmarks rallied too. The market is pricing in not just a temporary hiccup, but a sustained disruption. Traders are factoring in a risk premium for seaborne flows that could last.
Right, and some analysts are sounding pretty worried. They say if choke points stay closed and outages spread, prices could spike far higher, even into the $200 a barrel range, in a worst-case prolonged conflict scenario. But that's an extreme path, not the base case.
That's a good point, but I also think it's important to stress the range of outcomes. One path is fast diplomatic de-escalation, or a workable security solution for shipping, which would let traffic and prices normalize. The other path is protracted confrontation, which would force tankers to reroute around Africa, send freight and insurance rates much higher, and raise the price floor for a long time.
I mean, when you look at the data, the immediate pain shows up in refined product margins already. Higher shipping costs increase the landed cost of crude, and that can filter into pump prices for consumers in the coming weeks.
Yeah, and that's where the macro risk comes in. Emerging market importers and oil-sensitive industries could face higher inflation, and if that's sustained, it raises the risk of demand destruction and slower growth.
Quick reactions.
Right.
So, okay, who gains and who loses here? Energy producers and integrated oil companies typically benefit from higher crude prices because their cash flows improve if prices stay elevated. Companies like Exxon, Chevron, or Shell are the ones analysts mention in this context.
On the flip side, refiners and fuel-sensitive industries face margin pressure. Shipping companies and insurers are taking hits too, and the ripple effects touch consumers and broader economic growth if prices remain high.
Policymakers and markets do have tools. Governments could coordinate releases from strategic petroleum reserves. OPEC Plus could tweak production, and diplomatic channels could try to relieve the choke point. But analysts warn any reserve release would need to be large and sustained to bring prices back down materially.
And there are practical things for traders and watchers to follow. Daily ship transit counts through Hormuz, reported tanker liftings from Gulf terminals, statements from OPEC Plus about spare capacity, and moves in insurance and freight rate indices. Those data points will tell you whether this is a short shock or something more structural.
Yeah, that's a good point. One practical note, this conversation is for informational purposes only. Analysts note the risks and the scenarios, but this isn't personalized investment advice.
Exactly. We're laying out what the market is watching and why prices reacted, not saying anyone should buy or sell specific stocks. Okay, last quick takeaways?
First, the Strait of Hormuz disruption has real teeth. Traffic collapsed to roughly 6 ships a day from about 135, and that sent Brent up to about $116 a barrel.
Second, the market is pricing in a sustained risk premium. Watch ship counts, tanker liftings, insurer guidance, freight rates, and OPEC Plus statements to see which path the market leans toward.
Third, higher oil supports producers and pressures refiners and consumers. Inflation and growth risks rise if the squeeze lasts.
Got questions? We'd love to hear from you. Head over to stockalpha.ai, or you can ask us anything and we'll answer live. And while you're there, check out more market content.